James Knightley, Chief International Economist with ING, joins us now. James, good morning. Thank you for joining us. James, do you think, given the action by the Fed in last 24 hours, last 48 hours, uh, the calmness in the market has returned?
Yes, it certainly has returned relative to what we were experiencing at one point yesterday morning in US trading hours, where there was some extreme volatility. It does appear there is confidence returning that what's happened to Silicon Valley Bank and also Signature Bank may not be replicated elsewhere. There's still risks, there's still concerns, and regulators are going to be following things very, very closely. But it does seem as though we've got a bit more confidence that we're not going to see a whole domino effect coming through. And that's allowing sentiment to improve somewhat. But there's still a lot of caution. We've got the Federal Reserve meeting next week, and that's going to really set the tone, I would imagine.
Could go wrong from here? What looks like a spark looks like the spark is contained, but you never know that, spark could become a fire. So according to you, what could go wrong further?
Yeah, well, there's still plenty. I mean, my concern surrounding the US economy is that we are experiencing the most aggressive, most rapid pace of monetary policy tightening that we've seen for 40 years. And given that, there's a lot of uncertainty about how the economy and how the financial system will react. And we're always on the lookout for signs of stress. And this clearly is a sign of stress, that these rate hikes that have been very aggressive are now having a ripple effect or actually having a tangible effect on the financial system and the US economy. So that has led to markets paring back their rate hike expectations for not only next week's meeting, but through the rest of this year as well. And I guess, the concern, therefore, following on from that, is not only is the US experiencing higher interest rates, there's also an impact on credit conditions as well. This has already been apparent from the Federal Reserve's own senior loan officers survey. They go around surveying the banks and ask them what they're doing in terms of their lending standards. Are they making it more difficult to borrow from the banks? Are they putting up the cost? Are they being more restrictive? And they certainly are, according to the evidence. So not only are we having to contend with higher interest rates, we're having to contend with tighter credit conditions, i.e. banks pulling back from lending. And my fear is that what's happened with Silicon Valley Bank and Signature Bank is only going to compound those concerns, particularly in the mid-sized bank sector, making them even more cautious. And then also regulators as well, becoming more cautious. And you can quickly get yourselves into thinking about, well, this could be a sort of a snowballing effect in terms of it just gathers momentum. The banks pulling back, the regulators getting more watchful, the banks therefore getting even more cautious in terms of their lending. So I think the risks to the US economic outlook are certainly increasing, and the threat of a period of weak growth or possibly recession is certainly being intensified by what we've experienced over the last few days.
So, James, a couple of points here. Firstly, could we see more instances like SVB, or do you think it's early to call that?
I think it's far too early to call. I mean, there is a general view out there that these are one-off. These are specialists. These are lenders that focused on the tech sector, venture capital, very flighty deposits, and they put these deposits in Treasury securities. And of course, when Treasury securities fell in value as yields rose, they were hit on the balance sheet. And the hope is, or the belief is, that we're not going to be seeing anywhere near to the same extent this being replicated elsewhere, but it may be replicated in some ways. And that could, again, at the margin, make banks more fearful, regulators more watchful, and that will just tighten credit conditions in the United States, make credit flow more restrictive, and that's going to be a brake on economic activity.
James, so, just playing devil's advocate here, higher interest rates would also in some way mean, that of course is to curb inflation, but inflation also somewhere means higher demand. So it also implies that the economy is not doing all that bad, right?
No, I mean, it's at this point, it's not. The jobs market remains very hot, as we saw with last Friday's jobs report. Another good increase in employment growth in the United States, and today's inflation, or yesterday's inflation numbers, were also pretty hot. So there is still demand out there that is coming up against supply constraints. I would argue, though, that the jobs market data is the most lagging of all lagging data. We've got to look at the forward-looking aspects of this to determine where we're heading. And of course, credit and the state of the banking sector is very much a leading indicator. The health of that sector is very, very critical to the health of the economy further down the line. So yes, it's fine that the lagging indicators are looking pretty good. We've got to look at the forward-looking indicators. And I think credit, growth, the health of the banking system, the health of the financial system is far more critical in terms of determining where we are heading.
James, really appreciate your time. So glad you could accommodate this interview request.
Thank you.
All right, now let's talk about Indian markets. Now first, globally, things are looking calm. But what is the India connection? And then, based on yesterday's price action, the fact that Nifty struggled to recover from the day's low, FIs were selling. And now the FI sell figure is bigger than what the DI buy figure is. And that's always very disturbing. I mean, so our DI is running out of cash. That's not good news. FI trend in the month of March, they've been net sellers. And they've been net sellers for 4 days on the trot now. DIs have been putting a brave foot forward and they've been absorbing it. But now if you look at the figure of DI buying versus FI selling, the selling by FIs is much higher than the DI buying.